get right into it. Today, we're looking at a huge warning signal flashing across the global economy that almost nobody is talking about. We're going to explore this massive disconnect in the oil market, follow some really strange money flows in the bond market, and piece together what it all means for what's coming next. And I want to be clear, this isn't just some abstract theoretical exercise. We're looking at a situation that is unfolding right now. The consequences are already baked in, even if they haven't hit the headlines. So it's really time to wake up and pay attention. So, at the very heart of this is a huge mystery. There's this massive, never-before-seen gap between the price of oil you see on the news and what it actually costs to get a physical barrel delivered. And this isn't just random market chaos. The patterns here suggest this is happening for a reason. So, here's our game plan. First, we're going to untangle the story of two different oil prices. Then, we'll get into the real physical shortage of oil and the chasm between Wall Street's reality and the real economy. After that, we'll follow the money into the bond market, break down a geopolitical strategy that seems to have gone sideways, and finally, figure out what all this data is screaming at us. Okay, let's kick things off with our first section, a tale of two prices. To really get what's happening, we have to start by busting a pretty common myth about America's role in the energy world. You've probably heard this phrase, U.S. energy independence, thrown around a lot. It sounds great, but the numbers, well, they tell a very different story. The U.S. brings in about 6.3 million barrels of crude oil every day and sends out around 4.1 million. The math is simple. We're still a net importer of 2.2 million barrels a day. So this idea that the U.S. is self-sufficient is just not true. And that brings us to the core of the issue. There are really two prices for oil right now. You've got the paper price, that's the one you see on Google or in the news sitting around $100. But then there's the physical price, what it actually costs the refinery to buy a real barrel of oil and have it shipped. And that price, it's way up there, somewhere between $130 and $160. That's the price in the real world. So what you're left with is this massive spread, a $35 gap between the financial fantasy and the physical reality. And let me tell you, that's not just a big number, it's a completely unprecedented anomaly that should have alarm bells ringing. Now, if you look at the historical data, this becomes even clearer. For the last decade and a half, these two prices have always moved together, usually within $1 or $5 of each other. The only time they really separated was during COVID, when demand completely vanished. What we're seeing today is the exact opposite. This isn't a demand problem. It's a massive supply emergency, and the paper market is completely ignoring it. All right, so let's move on and actually put some numbers on this supply emergency. Because when you see the scale of the shortfall, it really hits home how serious this is. Because of major disruptions at key choke points like the Strait of Hormuz, the world is suddenly missing somewhere between 8 and 13 million barrels of oil every single day. To put that in perspective, the entire United States uses about 20 million barrels a day. We're talking about a hole in global supply that's almost half of America's total daily use. And this isn't a one-time thing. It's been going on for weeks now. One energy analyst did the math and calculated that the total amount of oil lost from the market since this conflict started is about 780 million barrels. That's a staggering amount of energy that has just vanished from the system. And if 780 million barrels is hard to picture, think about this. The entire U.S. Strategic Petroleum Reserve, our country's emergency stockpile, only holds about 400 million barrels. The amount of oil that's gone missing is nearly double the size of America's whole emergency supply. This chart really paints the picture perfectly. On one side, you have the daily shortfall, that huge 8 to 13 million barrel gap. On the other, you have all the world's available emergency supply combined. It adds up to maybe 2.8 million barrels a day on a good day. It's just not enough. It doesn't come close to filling the hole. So we've clearly established there's a real-world physical crisis happening in the oil market. You'd think financial markets would be panicking, right? Well, not exactly. It's like they're living on a different planet. So in this next section, let's explore this really dangerous disconnect. First, we have to really appreciate what oil is. It's not just gas for your car. Think of it more like the operating system for the entire global economy. It's a key ingredient in the fertilizer that grows our food, the plastics used in everything from cars to hospitals, and the fuel that moves goods around the world. So when you get a disruption in oil, you get a disruption in, well, everything. And this leads us to this incredible contrast. You've got Wall Street with the S&P 500 partying near all-time highs. And then you have Main Street, where everyday people are feeling the pinch, and consumer sentiment is in the gutter, near multi-year lows. These two things are telling completely opposite stories. And that brings up a really crucial point. Whenever you see this kind of gap open up between what the financial markets are saying and what regular people are feeling in their wallets, history tells us one thing very clearly. It's not the person at the gas pump who's wrong. You know, we've seen this movie before. It's like a historical echo of the 1973 oil crisis. Back then, when the embargo started, the stock market actually went up at first, reacting to some positive headlines. But then reality hit. The price of oil skyrocketed 300% and the market crashed 40%. It seems like today, markets are making that same mistake, chasing headlines while ignoring a massive shock happening in the physical world. Okay, now we're going to pivot a little bit. We've talked oil, we've talked stocks, but to see where the really big money is going, the smart money, we have to look at the global bond market. And what's happening there is a massive deal. And this whole thing isn't just about oil, it's about natural gas too. And with natural gas, there's this really clear, predictable domino effect. See, natural gas is the main ingredient in urea, which is the world's most common fertilizer. When gas prices spike, fertilizer costs go through the roof. That means it costs more to grow food, and that cost eventually shows up at your grocery store, usually with a lag of about 6 to 12 months. So check this out. This table shows how much it costs for governments to borrow money, their bond yields. And you can see, since this conflict started, borrowing costs have been climbing for the US, the UK, Germany, and Japan. But then look at China. Their borrowing costs are actually falling. And for the first time in over 20 years, it's now cheaper for China to borrow money than it is for any of those other countries. The message from that data could not be more clear. In plain English, the world's biggest investors are pulling their money out of the West and putting it into China. In a moment of global crisis, capital is treating China, not the United States, as the world's financial safe haven. This is a fundamental shift in the global order. And this shift is creating a really dangerous trap for the US, something called a debt spiral. Here's how it works. If high oil prices keep inflation hot, the Fed can't cut interest rates. High rates mean the government has to pay way more to service its enormous debt. To do that, it has to borrow even more money, which pushes interest rates even higher. It's a vicious cycle. And with US borrowing costs already creeping up to a critical danger zone, all the pieces for this are falling into place. So, this all leads to the big question. Why is this happening? How did we get here? Well, it looks like we're witnessing a major geopolitical strategy that hasn't just failed, it's spectacularly backfired. From the outside, the strategy probably seemed pretty straightforward. Step 1. Disrupt oil flows from the Middle East to hurt rivals like China and Russia. Step 2. Force China to pay way more for its energy. Step 3. Drain their financial reserves and slow down their economy. The goal? To put the US back in the driver's seat of global energy. That was the plan anyway. But what actually happened was the complete opposite. The US burned through its advanced missile stockpile, and to rebuild them, you need rare earth materials that are controlled by, you guessed it, China. So now, China has leverage over US military readiness, and as we just saw, it's become the world's financial safe haven. The strategy didn't just fail, it achieved the exact opposite of its intended goals. Okay, so let's wrap this all up. In our final section, let's cut through all the noise and focus on what the actual hard data is telling us is coming next. I think this quote really gets to the heart of the matter. You can play games in financial markets, you can spin narratives and manage perceptions for a while, but at the end of the day, reality always wins. You can't print a physical barrel of oil. Eventually, the real world asserts itself. So, what does this mean for you and me? The physical world is sending a very clear, very loud signal. All the data, from the supply shortages to the cost of fertilizer, is pointing in one direction. Get ready for higher prices at the pump, bigger bills at the grocery store, and inflation sticking around for a lot longer than anyone wants. Now, if you want to track this situation yourself, you don't need a fancy Bloomberg terminal. Just keep your eyes on 3 key things. First, that gap between the physical and paper price of oil. Second, watch the government bond yields, especially the difference between the US and China. And third, keep an eye on fertilizer prices. Those 3 things will tell you the real story. So I'll leave you with this one final thought. We're living in a moment where the official story told by the markets and the headlines is completely at odds with the physical reality of supply chains and money flows. The biggest question of all is, when a gap like that opens up, which one gives in first? History would suggest it's never the real world. Thanks for tuning in.